All right, we should be live now. If you can hear me, please drop a 1 in the chat, and we'll give everybody a minute to join here. Please drop. And there we go. And if you can hear me clearly, let me know. Let me know if my volume is too loud or too low. All right, lots of ones coming through. Thank you guys so much. Awesome, guys. Yeah, this is live, guys. So if I make a mistake, there's no going back. Welcome, guys. Welcome, welcome. Thank you so much for spending part of your Saturday with me. Definitely appreciate it. This is going to be a lot of fun. This is one of my favorite topics to talk about, and we'll give it just maybe 1 or 2 more minutes before we actually get going. This is recorded. I'll send out the replay via email later today. So again, if you have to take a step away for some reason, use the bathroom, no problem at all. This will, you'll always have the recording. And also, I saw a few questions about the model book. I'll be sending that out by that same email, so you'll have access to that. It should be a great resource. Hopefully you guys get a lot out of that. And this is one of the historical classical charts of Tesla, of course. Likely many of you guys remember it. And if you guys watch the video, this part right here should be interesting. We'll see if the current chart of Tesla matches this, or if we break below the 21 EMA to be determined. All right. Nice. We've got a bunch of people in here, hundreds. Very cool. Let me know in the chat where you guys tuning in from. I saw a few international folks in there. And I see one message about echoing. Just make sure you don't have the stream up multiple places. There shouldn't be any echo, and if there is, let me know, please. All right, Wisconsin. I saw someone from Peru, Texas, San Diego, Ukraine, Toronto, Scottsdale. Very nice. Oregon, New York, India. Very cool. Awesome. Berlin. Very nice. All right, all over. This is cool. It'd be cool to see like a map of the world and see like little dots lighting up where everybody's tuning in from. But this is awesome. France, nice. Bienvenue, Martinique, Philippines, Vancouver. Very nice, guys. Barcelona, nice. Cool. Don't tell me the score. Come on. But at least they're winning. That's Man United. Hey guys, welcome. Very cool. All right. So let's see. Let me just tweet out the stream here. Give me 1 second, guys. Okay. And I am recovering from a cold, so if it sounds a little bit like that, that's because it is. But I'll do my best to power through. This should be a great event. All right. So let's go ahead and get started. Welcome everybody to the first of a series of TradeLab Momentum Setup webinars. We'll be covering a few of them, from today breakouts to earnings gaps and momentum gaps, and then also pullback setups. That will be a fun one. This is the first webinar where we're focused on advanced breakout strategies. This is probably my bread and butter setup. This is probably the one I use the majority of the time. And it's amazing because it's worked all the way back since the early 1900s, going back to Richard Wyckoff. Every market wizard traded a variation of this setup. And it's because it's a factor of market dynamics. It's a factor of basically the effect of market dynamics with supply and demand, where stocks run up, they meet sellers, those sellers are absorbed within a consolidation, and then the longer term trend resumes. So this setup is always going to be in vogue when the market is right. And I'll talk a little bit about that, about what context this setup is best used in. And very simply, strong uptrends, especially coming off of a significant correction or choppy period where things really take off. That's when breakouts really excel, especially in the first few weeks of a new uptrend. Later in the cycle, and especially during a downtrend, the same setups that look great during and work great during a market uptrend will fail, and those pivots will fail. So it's always important to remember that context. So I want to mention that even before we get going. So let's push on here. I wanted to start with this quote from Nicholas Darvis. This is one of my favorite traders to study. I forget which book this is from, but it's probably from How I Made $2 Million in the Market. Here's what he said. I started to realize that stock movements were not completely haphazard. Stocks did not fly like balloons in any direction as if attracted by a magnet. They had a defined upward or downward trend, which once established tended to continue. Within this trend, stocks moved in a series of frames, or what I began to call boxes. They would oscillate fairly consistently between a low and a high point. The area which enclosed this up and down movement represented the box or frame. These boxes began to exist very clearly for me. And these boxes are synonymous with bases and ranges, as I like to call them. And it's what he traded. It's what he excelled at, trading the uptrend, trading the moves from base to base, from box to box. And that's what we'll be talking about today. And by the way, I was just reading this last night. It's a very quick read, but I found this awesome version of one of his books. This is, I think, his third book. After How I Made $2 Million in the Stock Market, and you can still make it in the stock market. It's Wall Street, the Other Las Vegas, a really cool old copy. I love finding old trading books like this. I would recommend the first two more. This is more of just a quick, fun read, but it's always cool to find a nice used book there. And I definitely recommend reading all his books. That's actually the book that got me started in the market. It was the first one that Dr. Wish assigned to me, How I Made $2 Million in the Stock Market. And it goes through all the highs and lows that you'll experience as a trader. And you see Darvish's evolution as he develops his process, his style, his box trading, his breakout trading methodology. So if you haven't read those books, that's my homework for you this weekend, is to pick up How I Made $2 Million in the Stock Market. It's an easy read. You probably read it in one day, and it's a lot of fun and more of a story than, it's not a textbook. It's a lot of fun to read. So, and let me know in the chat if you've read his book and would recommend it to others. All right. Quick sip of water here. Here's the overall agenda for today. First, we'll discuss the base breakout setup, what it is. Then we'll discuss identifying pivot points, because I know a lot of people have questions about this. How do you draw your pivot points? How do you determine the buy points for a breakout? Then we'll discuss screening for breakouts, my process for doing that, building focus lists, that overall process and funnel that creates, a streamlined, link between ideas all the way to execution. We'll discuss execution and entry tactics. We'll discuss gaps at pivots, because that's often something that people run into. An issue people run into with trading the setup is, how do you trade it if it just gaps above your pivot? What do you do? Do you buy it and hope, or is there some better way? And we'll talk about the way that I basically trade those circumstances. They'll discuss some key reminders, and then run through a few of the model book examples. All right, so this should be a lot of fun. Thanks again for tuning in. If you wouldn't mind right now, leave a like on the stream and subscribe if you're new to the channel. I'm putting a lot of work into my YouTube channel these days. I want to make this a great resource along with the Traderline channel. So if you don't mind leaving a like and subscribe, that would help me out immensely. I'm shooting for 90,000 subscribers shortly in the next few months, and you can help me get there. So please go ahead and leave a like and subscribe if you haven't already. All right. So again, here are kind of the key goals of the webinar. And if I do one of these 5 things, that's successful. But I think we'll hit on all of them. So first, we'll discuss the base breakout trading setup and early entries, why they're beneficial, why they're effective. Then we'll discuss a trading basis playbook. So what's your process for trading a base? How do you identify it? All the way through execution at early entries or the actual breakout. Then we'll discuss the entire breakout process and funnel, because for every setup that you have, you need to have a streamlined funnel that, like I said, goes from ideation, whether that's going through screens, going through watch lists, universe lists that you have, all the way through filtering to the best setups, best example of that setup. And that needs to be streamlined, because otherwise, if there's disconnects, that's where you can get discombobulated and miss setups, and we don't want that. So I'll discuss my entire breakout process, the key steps for that. And then we'll also just develop a process for identifying entries and pivot points. Like I said, a lot of people seem to have questions and want help with, how do you draw the pivots? How do you draw those lines that actually identify the proper buy point? So we'll talk about my process for that. And then we'll just study along the way key examples of historic and recent base breakouts. There's been a lot of great moves the past few weeks. Hopefully you guys have caught a bunch of them, in the quantum space, especially the, AI energy theme has been really strong, and we'll cover a bunch of those charts here today. So should be a lot of fun. So let's go ahead and dive right in. So what is the base breakout setup? The base breakout setup is a continuation setup, which is basically one that follows a prior uptrend and forms a multi-week consolidation, typically at least 5 weeks, distinguishing it from trend starting setups like the launch pad or more significant moves off the bottom. A key characteristic of the breakout setup is tight price and volume action within the base as the supply is being absorbed, and especially as you're moving up the right-hand side of the base. And what's great about these is they're signs of institutional accumulation. That price tightness is the institutions, supporting the stock. And also a great benefit of them is they provide potential early entries on range breakouts as the stock moves from those tight areas. And that's a lot of what we'll talk about today. And this early entry advantage gives us a few benefits over buying at the traditional breakout. First, you have a cushion going into the breakout because often there's some volatility. There's failed breakouts right at that level. But if you've entered earlier, you've got a cushion that's able to absorb those moves up and down, keep you in the trade. And so when it actually breaks out, and maybe that takes a few days, few weeks to let that volatility cease, then you're still on for the ride during the breakout. So there's a couple advantages for early entries, and it just gives you a better cost as well as also a tighter and more logical entry a lot of the times. And what does that do? Being able to manage risk tighter with a tighter stop loss allows you to size a little bit better and benefit more from the trend with that bigger size. So that's a lot of the early entry advantage. Then we'll talk about breakout confirmation. What do we look for after the breakout? What is the healthy price action that we're looking for? And then also we've got a few examples in here of a failed breakout that resets often at the base pivot or even a pullback to the 21 EMA. There's often a secondary buy point where everybody takes it off their radar. The base breakout failed. Everybody moves on to the next opportunity when it forms an even better setup back at the 21 EMA, tightens up in a range, and looks to break out. So we'll talk about all these things here today. All right. So as I mentioned, this is a setup that market wizards throughout history have traded variations of. This is a screenshot from William O'Neill's model books discussing this stock. I forget which one this is, but basically, I'm not sure this is Chrysler. I don't think it's Chrysler, but this is a large cup and handle. And what is a cup and handle? It's a large base. And even within this big weekly cup and handle, you've got this mini base consolidation and tight area right here that then his buy point is right after that tight area. So he looked for the exact same things that we're going to be talking about today. You can see the volume drying up within this tight area, the tight closes, and then the big volume coming from that tight area. And we'll talk about all those characteristics today. And then over on the right here, we have another great trader, Stan Weinstein. And this is a stage 2 continuation setup, which is a base breakout. You've got a longer term uptrend, a base consolidation, higher lows within that. And then we get the breakout at point A here, and we're off to the races. We're continuing on with the longer term trend. So the key point is here, going back to O'Neill, going back to Weinstein, going back to Darvis, going back to Wyckoff, all the great traders traded this base breakout setup in some respect, in some regard. They had their own process for it. Maybe they look for slightly different things, but they're all in general focusing on the same type of opportunity. All right, and here's an example of a base breakout and also an early entry. And let me know, and I do have the ticker symbol up here, but who can let me know which stock this is? Who will be the first one to say that? Let me know in the chat here. But basically, walking through this, we had a strong prior uptrend. We began the base right here, and the base begins when there's a high that isn't really overcome for at least 10, 15 days. That's when you can start drawing in the base pivot. And I see a lot of people saying IONQ. Well done. It's right here, so it's a little bit obvious, but well done, guys. And the base begins when you have enough consolidation that you can draw in that base pivot. And even if these two bars, overshot a little bit and failed here, I would still count the base as starting from this level. So again, there's an element of art to this. There's definitely a lot of science as well, but there's an element to art to this with drawing the pivots, with picking the key highs to look for, and I'll hopefully be sharing some processes to make that a little bit easier here today. But anyway, this is where the base pivot begins. We're oscillating above and below the moving averages. We break below the 21 EMA, and then we form a little bit of a tight area here, upside reversal off a 200-day moving average, and we begin the move up the right-hand side. And this is where I really get interested as a trader. I love looking for strong stocks that are in leading themes, that broke below the 21 EMA, and are now reclaiming that level and moving up a mature base. And then after that point, after the reclaim of the 21 EMA, I'm looking for a tight area to form. And we'll discuss exactly what I mean by a tight area, a range. We'll go through a lot of examples. But just in general, I'm looking for tightness up the right-hand side, ideally close to the moving averages. You can see how all of them are curling up under price here, supporting it. You can see all of these ranges are pretty close together. And from this type of range, you can set a clear buy point, and that's your buy. And you're entering early before the true base breakout, which is, quite a few points higher, and off to the races. This was a great trade opportunity, and there were a lot of them, LEU, Oklo, in the same type of space. Actually, no, this is quantum. Those are energy names, but a lot of the quantum names moved, a lot of the energy names moved, and there's just some great examples to study, and we'll go through a bunch of them here today. But this is just in general a quick example of what we're talking about. Overall base mature, move up the right-hand side, tight area against the moving averages, early buy point, traditional buy point, follow through, and we're off to the races trending above the moving averages. So that's just kind of that's the template I want you guys to imprint into your minds here. And notice, and we'll talk about RMV a little bit later, how low it got right during this base, showing you that it was ready. But first, it's always important to talk about what stocks to trade. So I mentioned a few things here. IONQ had a strong prior uptrend. It was part of a leading theme. And this is the Tigers framework from the Trader's Handbook, which if you haven't read, make sure you pick up a copy. It's on sale right now. Actually, the link will be down below in the description. I'll put it in the chat maybe at the end of the webinar here. But basically, we're looking for theme, innovation, growth, edges, relative strength, and the overall setup. And, this is a variation and, our kind of evolution of Can Slim. Can Slim is still perfectly valid, but we're just kind of adjusting it more towards the current markets where maybe revenue growth is preferred over just earnings growth. There's can be names that make amazing moves that don't have earnings or sales growth, but they're part of a great theme, and they're still great tradable vehicles, but they don't meet that strict criteria. So this is kind of the framework that we use to think about, does this stock fit the template of winners from the past? And you can use this to go ahead and do that. We talk about all this in the Trader's Handbook. All right. One other thing I really want to emphasize is that big moves come from big bases. So this is Tesla back in 2019 through 2020 timeframe. This whole 1,000% move started from actually a multi-year consolidation. This is just the right-hand side of a multi-year consolidation, but basically we've got a large base that we broke out of in 2019. We pulled back right to that pivot here at around April, March timeframe of 2020, and we're off to the races from there. But this whole amazing move happened after years of consolidation from this large base, and you'll see this over and over again. It's not to say that this base isn't tradable because it's not right here. It's just that you want to see big moves and longer term uptrends coming from these large bases. Here's another example with NVIDIA, and this has progressed even further since then, but we had a large correction back in 2022, large base here, and we're off to the races, and all these bases are tradable using the framework we'll be talking about today. Here's another Palantir, again, a longer term downtrend, consolidation stage 1, beginning of stage 2 here, and many base opportunities to participate in this move from this large base. So again, look for big moves coming from large bases and trade the first few bases coming from that large base. There's three main types of bases to focus on, and in the model book I'll be sending you today, there are great examples of each of these. The IPO base happens shortly after an IPO or direct listing. When the stock first comes to market, often there's a base that forms that absorbs that initial supply that comes to market, and there's often a really great move. And this is actually one of the best bases to focus on. Earlier in the year, we had Circle and CoreWeave as great examples of this and the opportunities around IPOs. So definitely study the IPO base. The bottoming base is more when we're transitioning from a longer term downtrend or a more significant downtrend to some sideways move and then a move up. And so it's more the bottoming phase of the cycle. And I don't focus on that too much, except when there's something like an earnings gap from that bottoming base. That's when I like to get interested. But the one we'll mostly be focused on today is the continuation base. The stock is already in an uptrend, and it's just an intermediate pause, pulling back into the moving averages, working off any supply. This often coincides with, an intermediate term correction or choppy period in the indexes as things take a rest and then continue on with the trend. So this will be really the focus on of today, but all of these you should study and you'll have access to a lot of examples in the model book itself. All right, so this is the Oliver Kell price cycle. Oliver Kell, U.S. Investing Champion of 2020. I've learned an immense amount from Oliver. Likely many of you guys have as well. And he's got an amazing price cycle framework that really just is a great example of what we'll be talking about today. Basically, he's got the 20 EMA, 10 EMA, and this line here, of course, is the price action. And this goes through the standard process that a base forms. We've got an uptrend that then breaks down. We trend below the moving averages. We tighten up below the moving averages, pop through the 21 EMA or his moving averages here. This is kind of the initial move off the base lows. Then these EMA crossbacks and basin breaks are basically the tight areas that we're looking for in the chart. So this is a great methodology to study. We've done a lot of webinars together, podcasts together. We have the Swing Trade Masterclass, which I highly recommend, where he goes really in depth into this with many examples. But definitely study this price cycle. And a lot of what we're talking about today is 100% complementary to this interpretation of price. But this is just kind of a framework, a blueprint that you can place on price action to get some expectation about what may happen next. So definitely study this if you haven't already. All right. And kind of putting this graphic into words, here is kind of the trading a base playbook. First, what we're looking for is when a stock is in a base, look for an extension down or gradual bottoming / tightness action, failed breakdowns, and then from those signs, look for points of power off the lows, relative strength, push off the lows. So if we go back to here's the reversal down, and then we're looking for signs of power, a push off the lows here. Then what we're looking for is the formation of the first higher low. And then as the base matures for entries, look for tight areas, moving average reclaims, gap ups, constructive pullbacks, or other entry tactics as the stock is generally moving up the right-hand side. So all these things, tight areas, moving average reclaims, gap ups, constructive pullbacks, all of that is happening up the right-hand side of the base. What I mean by up the right-hand side is here's the left side of the base as we go down. Here's the bottom, the reversal extension, the beginning of the move up the right-hand side. And then all of this is where we can use different entry tactics to enter the stock while managing risk tightly. So reclaims and moving averages, that could be an entry point. Pullbacks into the moving averages, that could be another entry point. Basin breaks, range breakouts, gap ups up the right-hand side, all of those are valid spots. And also just signs and indications of constructive price and volume action that suggests that the base is ready to actually go ahead and break out. And what's really key here is that these entries at the right-hand side should allow risk to be managed under 4% with a tight and logical stop loss. Tight means that it's within a few percent, and then logical means that there's a clear line in the sand where the setup would fail. So if you're using, for instance, a pullback to the 21 EMA up the right-hand side as your entry point, if it breaks below the 21 EMA, that's a logical spot that says, hey, that pullback failed, and it's time to put it back on the watch list, sell the position, and just wait for the next opportunity. Similarly, if you're trading a gap up the right-hand side of the base, you've got the low of that gap up day. You've got the close before that gap. That could be the line in the sand. You could use the 10 EMA that's coming up below the gap up day. So there's a lot of different variations that you can use. But the key thing is that it's got to be tight and logical. And without being able to define a tight and logical stop loss, in essence, you don't really have a setup because you can't manage risk and you're likely entering extended away from a proper buy point. So this is really, really key. And I've talked about this in prior webinars and probably if you've watched a few Trailline webinars, you've heard us talk about this before. But this is one of the key things that you have to understand as a trader. You have to manage your risk tightly and logically. That just sets up everything for success. Even if the trade fails, you're just out with a small stop loss, paper cut, and you can move on to the next opportunity. And then what you're doing at these early entry points is you're looking to have a full position set before the standard brace breakout. And again, this gives you a couple advantages. First, you're able to deal with any volatility that comes at the base pivot. Second, you've got a better cost. And then thirdly, like we said, at these early entry points, you're able to manage risk tighter because they're tighter entries versus at the standard base breakout. O'Neill would use a 7-8% stop loss, and that's just a little bit too wide for how I personally like to trade. And many of the market wizards who I've talked with and have interviewed, they like a lot tighter stops than that. So those are a few of the advantages of the early entries versus the standard base breakout. And then after the stock breaks out, hopefully it's working for you. What we're doing is managing the position versus uptrending moving averages, and we'll talk about that later in the webinar here. All right. So here's another example of this framework. Just to go through another example, we've got app. It really started consolidating back in this area. Here is where we broke below the 21 EMA. So this is the left side of the base. Then we've got an extension down, and look how it's supported off the 200-day moving average. You'll find a lot of stocks do this. We get an initial move up off that low. We get a higher low here, reclaim of the 21 EMA. So this would be an early entry point. We get a short tight area here, move higher, and then look at the volatility at the base pivot. This is why we want to be positioned earlier on or after the reset versus up here, because there's a lot of chop up and down. You're stopped out if you're trying to use tight stops. And just this area is just too obvious in terms of the market where, there's better opportunities often earlier in the base or after a pullback after this breakout pullback or, reset the 21 EMA. So this is a good example of a failed breakout that then pulls back into the 21 EMA. And then look at this tight range here. All these highs are lining up. This is what I call a tight range. You've got support off the 50 SMA, tightens up, and then this is the data act as it breaks through these highs right here. It also breaks through the base pivot, and we're off to the races. And I think this gained 70-80% in a very short amount of time. So this is kind of another great example, a template to think about and study, especially with regards to a failed breakout that resets at the 21 EMA. That's a variation of trading a base breakout that is really effective, especially in a little bit choppier environments. All right, so let's talk about the importance of tight areas. So as I mentioned, constructed bases will exhibit tight areas throughout the base formation. Maybe some of them will start to show it on the left-hand side, near the base lows, and then up the right-hand side of the base. But almost all of them, basically all of them exhibit those tight areas if it's a constructive base. So it's a key thing to look for. Tight areas should ideally be accompanied by a decline in volume. That shows that there's not much trading activity there that's being, pinned there by institutions. They're accumulating any shares that come to market, and it's a sign of subtle accumulation by those institutions. How long should a tight area be? Well, it can be as short as 1 to 2 days and probably as long as 5, 6, 7 days. That's kind of the sweet spot there. And I saw a question about, how much percent range that should be. I know Mark Minervini in the past has said within 10%. I like it tighter than that personally. And it kind of depends on the context of the stock as well. But I like it being as tight as possible within 5% ideally, because that allows you, again, to manage risk just a little bit tighter if you're using the range lows as your stop loss. And then to define a tight area, you're basically looking for highs and closes to line up around the same level. That's how you define the top of a range. You're looking for highs and closes to line up around the same level, and that forms your range pivot. And we'll go through more examples, a lot of examples on this exact thing. And then over the course of the base, ideally overall you're seeing a tightening of price action, coiling activity, and that's a sign of a constructive base overall. All right. So identifying pivot points, let's dive into here because I think a lot of people have questions about this. What is a pivot point? A pivot point is a clear short-term line of resistance that when a stock breaks through that level, the expectation is a burst of momentum higher, ideally triggering additional pivots such as the base pivot or additional pivots above that add fuel to the fire. And what we're looking for is confluence of ranges, is confluence of highs / tight closes. A base pivot, there's a couple different types of pivots. A base pivot is the traditional one that, we talked about. It's the actual high of the base. A consolidation pivot is a shorter term consolidation within a base potentially, where it's not as long as a base, it's not a few weeks long, but maybe it's 1 to 2 weeks of tightness. This is what Ross Haber really likes to look for. And then range pivots are even shorter. They can be, as short as 1-2 days, but go out to about a week in length, I would say, is what defines a range pivot. And what's best is when multiple pivots line up. So you've got a breakout through a range pivot that triggers a consolidation pivot, that triggers a base pivot. That's when we see those breakout moves that really take off and go. Either you're on for the ride or it's left the station without you. This is the best possible scenario. You get on early with the range breakout, and then that triggers the actual base pivot breakout, and you're on day one you're up 5-10% already in the stock. So this adds fuel to the fire. And when this situation occurs, expect a fast move. So let's get into an example. Here's IONQ again. So think to yourself first, where is the base pivot? Where does the base actually begin? I'll give you just a quick pause here. So think about that to yourself, and we'll also talk about the range as well. Okay. So for me, the base pivot begins where we have a move up, a defined high that begins, and then the stock starts pulling back and consolidating and never really breaks above this level for at least around to here. At this point, I would be comfortable drawing a line in right here, and I'll show a finished version on the next slide. Draw a line in here that defines the base pivot. As soon as we're about in this area, it's enough consolidation to define a key pivot here. And these two bars right here just kind of confirm that this level is significant. And this bar as well, as it approaches that area, it's rejected down off of it. So those things kind of confirm that this level is key. So this is the base pivot. Then after this extension down, we start moving up the right-hand side of the base. We have a high within the base that then pulls back and tightens. And look at how all these highs are kind of lining up in price. This becomes another pivot right here. So we're looking for these highs to generally line up. It doesn't have to be exact, but you're looking for basically where highs line up, closes are tight together, and there's overall contraction. Look at how we're oscillating above and below here. And then here it's a lot tighter, a lot of contraction. All the lows are close together as well. So here we've got the high of the range. Here we've got the low of the range. And even if we had a shakeout day, a big upside reversal that closes back in the range or reclaims the range, it still would be a valid range here with this still the low, because that's kind of a shakeout. This is the key low. That low would just be another area of interest if we break down further. So this is the range from high to low. And then this is the breakout through the range that then triggers the base breakout. And then we're off to the races like I talked about. So here is the final thing that we talked about. This is the base pivot. This is a very short-term range. Look at how these highs line up. The closes are very tight as well. We get expansion from that range. This is the benefit of playing ranges, is we get strong expansion. Then we move up and form another defined high, which there's no breakthrough for at least a few days. That's where we can draw this line in. And then here, you can see this dotted line here. This would be the action buy point for me, because these highs, even though it's within this overall range, are a little bit tighter and are just the better buy point for me to look to act to buy on this bar, setting my stop at the low of the day, and it either works or it doesn't. And on this day, it breaks through the range. We have another tight day, a setup day. We'll talk about this in just a minute. Reconfirms, base breakout, and we're off to the races. So that's another example of drawing these pivots in. And it doesn't have to always be, like I said, at the exact highest point of the range or the exact lowest point of the range. It's kind of the range that covers the high or low that covers like 95% of the price action. So, around here, those are kind of the key levels that define that range. Remember, there's always going to be a little bit of randomness, volatility, even within a range. So here's a little bit more of a definition. A range is a short-term consolidation, 1, 2 to 5 days, that is generally contained between identifiable high and low. These highs and lows may not be the highest or lowest points, but should contain around 85 to 95% of the price action within that range. And actionable ranges provide low-risk entry points up the right sides of bases or near key levels like a base pivot or moving average. Remember, with the app example, we had a range that formed after a failed breakout that reset near the 21 EMA, so it's near that key level. Ranges can be primed with short-term patterns like an inside day or upside reversal, which represent contraction or short-term momentum swings to the upside. So this is really key. So let's dive into some of these short-term patterns. So these are what I call priming patterns. And what's really important as I go through this slide is you don't just want to memorize what these look like and just say, okay, I memorized that this is one of it. I'm going to buy it because, this got the short-term pattern. You want to understand what's the supply and demand dynamics going on behind the scene. And you always want to use these patterns in context. So for the purposes of this slide, what we're thinking about is there's a mature base where we're moving up the right hand side. There's a range that's forming. And then this is the very right side of that range where we've got an inside day, we've got an upside reversal, we've got a positive expectation breaker, or we've got a tight setup day right near the high of that defined range. That's when you want to be looking for these priming patterns. And if you go back and study strong breakouts, you'll be amazed about how many of them had an inside day the prior day, or upside reversal, or a positive expectation breaker, or tight setup day. Almost all of them come from this type of short-term pattern. And that's why it's so helpful to be able to identify these within a mature base, because identifying these the day before allows you to put that stock on your focus list the next day and catch that breakout. And again, a lot of what we're talking about today is, characteristics. But what do those characteristics allow us to do? They allow us to improve our process and get more of these stocks on our focus list so we can trade them and profit from them. That's the goal. So these priming patterns are really great ones to use and understand so you're ready to actually trade that stock the next day. Oh, you see a mature base in a leading theme name that has an inside bar right near tight range, right near the base pivot. Okay, that's going to be my A+ setup for the next day. That's going to be my number one opportunity. That's the one I'm going to be focused on in the first few minutes of the trading day. So that's what we're talking about with these priming patterns. So let's dive into each of them. First, inside bar. So inside bar, likely many of you guys know, all the range from high to low is contained within the prior day's bar. So what does that represent? That represents contraction, an equilibrium in supply and demand. And each of these patterns, I've got this note right here, each of these patterns either represent contraction, where price is being compressed, there's equilibrium, there's a spring being coiled that then, as we expand from this tight area, leads to that expansion, or it's a short-term momentum change, which we'll get into with the upside reversal. But an inside bar, like I said, all of this range is contained within the prior day's range. The earliest buy point is through the high of the inside bar, in context of a mature range, a mature base, all of that. And you're looking for expansion and a quick move through this high, through this right here. So you're looking to buy through this inside bar high. So this is contraction. The next example is an upside reversal where we've got a high and low here. And then this bar low undercuts the prior bar's low, and then we rally up from it. So what does that represent? We've got a bar right here. We have follow through to the downside or move to the downside from that bar, and then institutions step in, buyers step in and reclaim that low and push the stock up higher, and we have a defined high right here. So we've got a short-term momentum change from the downside to the upside. Again, thinking about this in context, the mature base, the range, maybe this is against the 10-day moving average, the 21-day moving average where it found support. So you're looking for this in a strong context, not in isolation. So that is the upside reversal. Next up, we've got the positive expectation breaker where we've got a bar with a negative close the day before. And in the chat right now, after a day like this where we open up here, we close down here, what is the expectation for price action the next day? Do you think the stock is going to fall through to the downside, move lower, move up? What's kind of the expectation? And put it in the chat right here what you guys think. I want to see some responses here. What's your expectation? Yeah, gap down, so move lower, right? But instead, what a positive expectation breaker does, and this is a Mike Webster concept, is instead of a move lower and gap down, we gap up and hold and even have a good close. And so that high, which sometimes will line up with this high right there, becomes that short-term pivot and primes the overall setup if this happens within a range. So think about, if there's a bar here, there's a bar here, and this bar breaks below the lows of all those bars, everybody's going to take that off their radar and move on to the next setup because it's breaking down, right? But instead, we have a gap up and hold, and that reclaims the range. That's when a stock can really get interesting and break out the next day and just go off to the races because it shook everybody out, and now everybody has to rebuy who wants in. So that is the positive expectation breaker. Next up, we've got the tight setup day. This is actually a newer one that I've kind of conceptualized actually over the past few months here is, we try to break out or, overall try to, test this pivot, but don't actually break out. And again, a lot of people just view this as a fade and a stock that didn't work. And again, you move on, throw out that stock and move on to a better stock that's going to work, greener pastures. But instead, overall, it's a very tight day, either based on the range from high to low compared to normal price action. So maybe a normal range throughout the day is 4 or 5%. This range is, 1 to 3%. That represents tightening, but also between the open and the close of that day, ideally they're closing very tightly together. So again, a sign of subtle contraction. And from this type of day, a tight setup day, we often get strong expansion. So it's kind of like the inside bar where it's representing contraction. And even though it was technically a failed breakout, a failed pivot breakout, it's just back in the range and set up and even a better setup than before. Because if we break out, you can manage risk at this low versus something that's all the way down here. So these are kind of the 4 priming patterns that I want you to pay attention and look for in the examples as we continue on with today's webinar. And again, all 4 of these, you want to understand what's going on behind the scene, how people are getting stopped out below this low and then it reclaims enough to rebuy, or there's a big shift in momentum from expecting a gap down to now we're gapping up. There's an element of people getting caught off guard with these 2 setups. And then also with these 2 setups, just overall contraction and tightness and equilibrium, that then from that tightness comes expansion that we can profit from on the breakout. So that's what I want you to understand about these patterns versus just memorize this is what an inside bar looks like, this is what an upside reversal looks like, because then you'll be able to use this creatively. And if the positive expectation breaker looks a little bit different like this, you'll still be able to identify it and interpret it if you understand the pattern versus just memorize this is what every positive expectation breaker looks like. All right, so with that said, let's move on. Let's go to another example. This is RKLB from last year. I'll go ahead and zoom in, and we're going to kind of go not quite bar by bar, but pretty closely bar by bar, and talk about some of the short-term patterns and also the ranges here. So here we've got an extension down, the start of a base. We've got a short-term range that forms here. This is where I would draw that pivot across. We get a gap up out of that range. We form another range here, and this is where you have to get a little bit creative, because this bar, look how tight this is. Yes, it's a little bit of a downside reversal, but it's relatively tight from open to close. We have the pivot through this high. I would use this high versus this high because this is the upside reversal day, which primes it. This is a tight day that primes it. And then we get a range breakout from that level. So again, this is an example of a tight setup day that isn't quite what we just looked at. But again, you want to use the concept, not just memorize exactly what every single one looks like. You want to be able to think dynamically. Then we move up, we form another consolidation pattern. We can see how it's finding support near the 21 EMA. What is this? We have a break below the 21 EMA as well as these lows. This is a negative bar, right? So what would you expect the next day to do? Let me know in the chat here. What would you expect to happen if you didn't see the price action? Oh, there we go. If you didn't see the price action after this bar, what do we expect this to do? Probably test the 50-day moving average and move down, right? Well, instead, we have a positive expectation breaker reclaiming the 21 EMA. So what do? We start to draw a pivot line across these highs, and we've got a nice tight and logical stop because the 21 EMA is right here. And what happens the next day? The setup gets even better because we get an inside bar still within this range and further tightness, further contraction. And what are we looking for? We're looking for a range breakout through these highs. Boom. There we go. Enter early in the day, stop at the low of the day, lines up right with the 21 EMA. Very tight stop. If you want to even a little bit wider stop that's still very, very tight, you can use this prior low. So maybe it decreases the chance of you getting shaken out. But I personally would use the low of the day. And this is the pivot right through this bar right here. We expand up. Let's talk about this consolidation. We move up. This begins to form a range. We have a slight move up and then another range that forms right here. And look at this. So we get a move up, inside day, very tight day overall from high to low, open to close. So this is a tight setup day. Then again, just like this situation where we have a positive expectation breaker and then the setup improves even more because of the upside reversal inside day, we get an upside reversal and look how tight the open and close are here. And all of this is lining up right here. All the pivots are right here. And from this bar, We're watching for a range breakout through this high. That triggers this high. That triggers this high. And boom. We're getting this big bar because it's coming from this contraction. And that's what I want you to train your eyes to be able to spot in real time, so you can put this type of name on your watch list. All right, moving up, we've got another consolidation here. We move this high and don't break above this level. So this is a consolidation pivot. All right, we're getting a little bit tighter. We've got an upside reversal. Things look, there's a range contained between this high and this low. We're getting a little bit tighter here. Boom. Sorry, it keeps showing the next bar. What is this? A tight setup day inside bar. Extremely tight. Look how tight this bar is relative to all these other bars here. This is about as tight as this bar right here. And from tight setup days, especially when they're inside days, we're expecting expansion. Boom. And what happened here? We actually got an undercut of this low before we took off. This is called an undercut and rally range breakout. I'll show an example and more examples of this in a second. But the range breakout entry would still be here, but you could even buy it earlier as it reclaims this inside day bar low and takes out. And we get almost another tight setup day after this breakout. This is constructive price action after the range breakout. Tight day. Look at the open and close very close together. A little bit of a wide range bar, but still pretty tight overall. And then boom, the range breakout and expansion really happens right here. So again, this is stuff I want you to be able to spot in real time, and hopefully these examples help with that. And I think that's the last example. Actually, one more here. So we have a big fade here. This becomes a key level. We start to consolidate below that level. We're pulling back into the 21 EMA. We've got an upside reversal off that level, a sign of demand. Boom, early move higher. So maybe you caught this, maybe you caught this move through this high or not. But regardless, what do we have here? We have an inside bar, a prime setup. And look at where this inside day high is lining up. You've got this level here that lines up with these highs. That's what we're looking for. And this is kind of the 95% line here of this range. So again, we're primed here. And there's the range breakout and expansion. And then this continued on and doubled from this point. So hopefully that's a good walkthrough showing how to actually look at those ranges and priming patterns in real time. And here's basically a marked up chart of all those ranges that we talked about. So you can examine this on your real time, on your own time, and look at all those spots and identify. And the best ones happen near the 21 EMA. This is another just a side that I want to mention. The best range breakouts for me are always against the 21 EMA. It just works. This one worked, but I like ones near the 21 EMA. It just gives me that confidence and also allows me to manage the trade really easily, because once you have this range breakout here that pushed higher, you're just watching that 21 EMA and that becomes your line in the sand to manage the position. And as long as it's above that moving average, you're gold, you're in profit, and you can quickly move your stop loss to be on a close below that 21-day moving average. All right. So that is RKLB. And here is just something that can help you as well if you're newer to identifying it and just want an objective way to look for these tight areas. Is I developed the indicator relative measured volatility that basically identifies these tight areas for you. When it goes to zero, it's showing tightening price action. You can see at all the spots that we talked about, we're approaching zero or at zero right at this point. So this is a really useful indicator. Most indicators don't help you spot buy points. It's more just a measure of momentum or a turn or change like that. But this can be really helpful to objectively determine, all right, we're within a range, we're tightening, where's my pivot now? And also what's great in DeepView is you can screen by this. So you could look for stocks with RMV under 5, under 10, and look for all those names and look for tight areas up the right-hand sides of bases. I've got an entire webinar on RMV. It's a really powerful concept. So definitely watch those if you haven't already. All right. So once you've identified a range, again, we've talked about identifying the ranges, the priming patterns, all of that. How do we actually trade it? How do we enter? How do we execute? And there's kind of 4 main ways to trade ranges. First, accumulate versus lows, where you've got a defined range. Picture this as like maybe 3 days of price action where this is the defined low of that range. You could enter as it approaches that low and bounces up. That would be kind of accumulating versus the lows. Then you've got the undercut and rally, where again, this is maybe 3, 4, 5 days of price action where there's a defined high and low. We get an undercut of that defined low, quick reclaim. That could be your first initial entry. And then the standard breakout as we break through the high, and then we're off to the races. The third one is buying tightness anticipation, where you've identified a tight range and we're starting to form a higher low and looking like we're about to break out through that level, and you enter, setting your stop at that higher low. That's kind of anticipation setup. Then we have the standard base breakout, where you're waiting for an actual breakthrough that defined high of the range. You enter here, set your stop at the low of the day or the higher low, and look to trade that actual standard range breakout. So those are kind of the four main ways to actually trade these ranges. So let's dive in a little bit deeper to each of them. So again, accumulate versus lows. We've got maybe a move up the right-hand side of the base. We have a range for 3, 4, 5 days. It looks to be respecting a level. And every time it's pulling back into this general level, we're looking for a bounce off of that level or just respect. On an intraday chart, it's forming a intraday low versus that level. And you're just kind of adding pieces of your position. You're adding 10% here, 25% here, 50% here. And you can, of course, add this into your arsenal with the standard base breakout, where you say, okay, I'm going to accumulate 50% of my position with a very tight stop versus the range lows, and then add the other 50% of the position I want on the actual breakout through here that confirms the range breakout. So this is a way that you can kind of combine different range trading techniques to build your position over time. This is how a lot of the great market wizards build, 30, 40, 50% plus positions, is they do it still by managing risk, by buying at multiple points as the base progresses and building into their position so that they're well positioned before the base breakout. So that's accumulating versus lows. Here we've got an example with Tesla before this range breakout. This is something I use to accumulate my position here. Is we've got this gap up, we've got the move up. So visualize this area right here, this gap up and move, as this move up here. And then this is the range that's forming against this key level. And then I accumulated versus these lows each day a little bit, anticipating this base breakout, and then you can add on the actual range breakout here. But accumulating versus these lows here, I use my stop at the 10 EMA, just kind of riding this higher. So that was my level in the sand. If we broke below that, I'd sell, but I accumulated a little bit on these days, and then you can add on the base breakout and join on for the ride here. So this is a great example of how you can use a key level here where it's respecting, there's a range forming above that level, and then manage risk as you're building a little bit into your position and look to add as we actually break out through the range. So this is an example of accumulating versus the lows. All right, anticipation. This is when we've got an existing range and we're actually pushing up towards the range breakout. It looks like it's going to break out. You can set your stop at the low of the day, likely the relevant intraday higher low, or even the low of the range if you like to keep it a little bit wider. I 99% of the time set my stop at the low of the day as we're pushing towards this range breakout. That's just what works for me. I like being right or wrong, and if I'm wrong, very tight stop loss hit. If we just reverse down, don't break out, I'm out, no harm done really. But this is an anticipation breakout. Here's the exact same example of Tesla, and you can actually see even more clearly on, this is a 15-minute chart, how we're respecting this level. So this is what you want to see when you're looking to use that accumulating versus low technique, is you buy a little bit every time it tests this and setting your stop at a clear, line in the sand down here below the level. And every time it moves up on that level, you can add a little bit more, and you're just building into your position. But then here, we've got the defined range. We pulled in close to the low of the range, but then reversed higher. And then early in the morning, we started to move up towards the actual range breakout. This is the range breakout on the daily chart. If I go back to here, this is the level that we're talking about. So this is that level. We're starting to move up towards that level, and you buy anticipating the range breakout, setting your stop at the higher low, anticipating the breakout, and then we're off to the races. And that's how you use the anticipation versus just buying the range breakout would be buying right here. So it's a very subtle difference, but you can manage risk a little bit tighter, maybe size a little bit bigger, or maybe you buy a little bit anticipating and then buy the rest of your position, the last half, the last 25% on the actual range breakout yourself. Again, each of these four ways to trade a range can be combined with each other to build into a sizable position while managing risk. That's what's key, while keeping risk very, very tight. And we're off to the races and breaking out, and we know what Tesla did next. Next is my personal favorite, the undercut and rally. Again, we've got to move higher. We've got a range that forms. we get a move lower below the defined range, and then we quickly reclaim it. And often this move down and reclaim might happen on a general market gap down, or a gap down on news that is quickly bought up. And this could be an oops reversal, and you enter through that defined low. And ideally you buy there, set your stop at just below the low of that kind of turn, and then you can even add on the traditional range breakout. So here's an example with Oklo. This is pretty subtle, but this is an undercut. Is you've got this mature base. We've got to move up the right-hand side. We're pulling back into the moving averages. We have a big upside reversal showing demand. Then we get a tight setup inside bar. Actually, I'm not sure if this is an inside bar exactly, but it's in the spirit of an inside bar. And this is the defined range. This low of the inside bar is the low of the range. This high is the high of the range. Then this next day, we initially move lower, slightly undercut this low. And this could be your early buy point as we reclaim and move up back through that low. And then you can add on the traditional range breakout, and we are off to the races, and Oklo did tremendously well. So this is a great example of undercut rally, and you'll see this all the time with ranges, especially maybe shorter ranges where, this range really is 1-2 days. And very quickly you get a undercut rally, and we're off to the races. So that's a great example here with Oklo. Then, of course, we've got the standard range breakout. This is the traditional way to do it. You're actually waiting for a break through that defined level. And here's an example with LEU. This is the range pivot. I kind of, so as this moved up, this becomes the range pivot, this high right here. As we build out this range, it kind of gets a little bit, I start to move the pivot a little bit lower to line up with the highs a little bit better. And this upside reversal becomes the actual level that I pulled this down to. And that becomes my range breakout level. And we're off to the races after this. And so this is just a traditional range breakout. Again, we have a nice setup day the day before, upside reversal, very tight open and close, and nice upside reversal the day before showing demand. So I love seeing an upside reversal within the range and then a tight inside day or tight day overall. That really tells me to put it on my daily focus list for the next day. All right. So talking about we talked about the 4 different ways to trade ranges. What about the overall process, the trade execution? How do we actually execute our orders? First, in general, we want to focus on promising setups and leading themes with many edges. Again, fitting the Tigers framework. Each day, we want to narrow our daily focus list to 1 to 4 stocks based on the readiness and quality of the setup. Readiness is determined by, do we have a priming inside day with tight closes? Is it near the 21 EMA? Is the theme acting really nicely? Is all the themes setting up together with tight ready bases? So that's kind of this readiness, and this is kind of the art in determining whether stock is ready to go. So look for theme, ability to trend cleanly. So this is a key thing. I put out a tweet, I think yesterday actually, when choosing between 2 bases and they look similar, maybe it's in the same theme, I look to the left on the chart and look at a prior trend, a prior trending period. And if it's able to trend beautifully above the 21 EMA, linearly, just, not much wiggle and jiggle up and above and below the moving average, I'll prioritize that setup versus the other one that maybe didn't have quite as clean a prior trend, because that stock has already shown the character, the ability to trend nicely as after we break out. And that's what I want to have when I have a position, is a stock that trends cleanly and then it breaks down and I'm out of the trade and there's not a lot of decisions to make. I want a stock that trends cleanly, so it's very easy to make a buy, hold, or sell decision. Again, RS, relative strength, this is a stock showing relative strength. What is the overall tightness of the setup? And then what I do when I have identified, 1 to 4 stocks is I set early alerts about 0.5% below the pivot I want to, below the range pivot. So here's an example. We've got the range pivot here, this black line here. My early alert is this orange line, a little bit below the pivot. So I'm actually watching the stock, and I'm notified when a stock starts pushing up towards the pivot. And then I can use either the anticipation setup, the anticipation range breakout, or just have it on my screen watching the actual range breakout. Take a look at what volume run rate is, what are other stocks of the theme doing. But this early alert is so key. It allows you to not be reacting and trying to buy a stock after it's already 2-3% above the range pivot, but anticipating the range breakout. So you're ready to go. You've got your order already set up in your broker. You have your stop loss planned out. You know all that stuff before it actually sets up and actually goes. So this early alert is a key part of the process to make sure you don't miss the best range breakouts. So again, here's the entry. My stop loss is 99% of the time the low of the breakout day. And that's how you do it. So again, after the open, recheck versus parameters just to see whether the stop loss is going to be tight enough versus the low of the day. I prep order in with my broker. You can do that and set it up. So you just have to press buy when it actually triggers and enter if it's pushing through the pivot. And there's no real, if and or buts, if and or buts, I forgot the actual phrase. But yeah, you just enter if it pushes through your pivot and meets all your criteria. So that's the overall trade execution process. Here's an example with LEU. This is one I entered on this day right here. Basically, we've got a range defined here. Here was my early alert, which was below the actual range breakout. This on the daily chart was a little bit higher. This is my early alert. I was watching this as well. This is one of the 4 stocks I had on my focus list that day. We initially pushed lower and then showed demand off the low. So there's kind of like an undercut and rally range breakout here. I was notified on this bar, and then I bought the range breakout as it pushed through and actually triggered the range breakout. So this early alert allows me to have it on my radar. I bring it up on my chart. I see the strong demand off the open, how it's consolidated right below the actual daily range breakout, and then you enter on the range breakout itself. So that is an example with LEU of putting that early alert into practice. And I like putting these at kind of intraday key highs that are a little bit lower than the base breakout, the range breakout itself. I know here on this slide, I say around 0.5% below the pivot. I kind of like to use technical levels to determine where exactly I put it. Right above this high would be spots to put early alerts in my opinion. And then beautifully, after I'm in this trade, it immediately pushes higher. We're trending above the daily anchored VWAP. That's ideal. That's what I want to see. And we're also trending above the intraday 21 EMA here. And this is the best type of breakout. It just goes and trends the entire day. Sometimes we get some basing intraday, but overall it's acting beautifully if it's trending above those moving averages, as well as the intraday anchored VWAP. So that is an example of trade execution. All right. Bonus, what happens if we gap above the range? Let us know in the chat. Have you had experienced this? You would see the perfect chart, the perfect setup, and then it gaps above your pivot point. Let me know in the chat if you experienced that. I see a question actually. Do you look for volume at this point? I will look quickly at volume run rate, but for me, I see the strength off the open. I see the volume picking up versus recent volume, and that's enough for me. But price action is always more important than volume in the moment, especially for range breakouts, because honestly, not all of them have bigger volume than normal. It's more the base breakouts where you see big volume because more people see that spot and are acting upon it. So it's more about how price is acting, and I see this demand bar off the lows, off the open of the day. So I'm looking more at that versus volume, but it's always good to see good volume coming in. So hopefully that answers your question. All right. So we've got a gap up, and this isn't like a catalyst gap. This is just a gap above the pivot. And how do you manage this? Well, I look for an intraday pullback or U-turn and then look to place my trade. I don't look to just buy the gap and hope it goes up. I'm still trying to use a technical level to manage my risk tightly and logically. So here's an example with Robinhood. This was the base here. This was a recent example. You've got all of this here. We have the gap up due to the S&P 500 inclusion that is actually triggering the base breakout. How do you buy this while managing risk? Well, here on an intraday chart, you've got the anchored VWAP reclaim. That's kind of my typical. I'm looking for a base consolidation, an intraday base, and then a push higher. And then I set my stop at the low of the day and look to ride that gap and go higher. So that's how I typically handle it. I've got another example here at Palantir. This is from this nice defined range, but we get a gap up. So how do we manage this? Well, on the gap up, we have a little bit of a move higher, a pullback, and then an anchored VWAP reclaim. You can set your stop at the low of the day and manage your risk. And that would be a way to position in this name after this gap up. And Brian Shannon kind of developed this methodology. He's got some great resources on that. So definitely look to that. And I'll maybe make a video completely about this concept to explain it in a little bit more detail. But that's a few different ways that you can handle a gap up is you wait for an intraday pullback and U-turn, anchored VWAP reclaim, and then enter there, setting your stop at the low of the breakout day. And sometimes you're going to be stopped out. That's part of trading. But then you can look for a reset, an upside reversal, a tight day here. So, for instance, if this formed a tight day here, you could be watching for a range breakout from that tight inside day. So there's different ways. And again, a lot of what I'm sharing today is kind of not necessarily formulaic, but it might seem formulaic. But really what I want to emphasize to you guys is that the different tactics we're talking about, the different way to trade ranges, the 4 different ways, the 4 different priming patterns I talked about, use those creatively to work your way in to a promising stock that fits all the characteristics of a market leader. Not all charts are going to be textbook perfect. Not all charts are going to break out and work beautifully the first time. You sometimes have to do work to work yourself into a leader. And that's what these different tools, these different entry tactics I'm talking about today, these different characteristics allow you to do, is you can mix and match them to work your way in while managing risk tightly and logically into a promising stock before the true breakout. That's the larger concept I want to share with you today. Is we're just trying to identify a stock in a mature base that has potential, is part of a leading theme, strong earnings growth, strong sales growth, everything going for it, and then find a way to manage risk and enter the name while building enough size in the position to make a difference if we actually get a trend and we break out and go and move the needle in our accounts. So again, it's not about memorization. It's about using the tools I'm sharing today to be able to think creatively. I'm having trouble with that word today for some reason. To be able to think creatively to work yourself in while managing risk tightly and logically. So that's kind of the larger concept here. And here's that anchor view I've reclaimed again. Here's another way to do it. So this is the NVIDIA. This is what I use to enter this name. Is you have a gap up here, and then I bought the second day. So if we have a gap up and push higher and then kind of a fade and tightness into the end of the day, I'll watch for day 2 strength, so the day after this move higher, and look for reconfirmation and look to enter off the open. So that's kind of how I use that. So this would be another way if you don't want to use intraday entry tactics, is just look to enter the next day. If we kind of gap up, hold, and then push higher the next day, that can be another way to enter while managing risk. All right. So getting into position management, I'm going to be doing a webinar completely on this, and I've done some in the past, so this won't be really the focus. But after the entry on day 1 to the day that you enter, what I'm looking for is a trend above the daily anchored VWAP, where you anchor it from the day's open. Ideally, we close right near the top of the day's range, ideally up a few percent from your entry. But if it squats day 1, look for reconfirmation the next day. Similar to kind of what happened here with NVIDIA, you could have entered here off the open, it squatted, but it didn't violate your stop or didn't violate really your entry at all, and then it went the next day. So if it squats, don't give up on it. Keep an eye on it, and if you entered, don't necessarily sell your position unless it's a choppy, defensive type market. But if it's a risk-on environment, look for follow through the next day, because a lot of people see a squat, take it off their radar, and then it goes without them, and then they're trying to chase it later on. So keep an eye on it. So look for reconfirmation the next day. Then day 2 through 5, look for follow through, constructive tightening and reconfirmation. So stair steps higher, move higher, tight range, reconfirmation, tight range, move higher, pull back the 10 EMA, move higher, reconfirmation. That's what constructive price and volume action looks like. Day 7 through 20, look for a trend above the 10 EMA. After a breakout, shortly after a breakout, I want to see the stock respect the 10 EMA. That's what the best ones do. And then later on during the trend, I want to see it trend above the 21 EMA. So ideally, the majority of the trend is above the 10 EMA, and then there's blips down to the 20 EMA every now and then. That's what the strongest stocks do if you go back and study their trends. So here's an example. This is Tesla here. This is the 10 EMA, this orange line. We see respect for the 10 EMA here up the right hand side of the base and thereafter. And now we've got a blip down to the 21 EMA. So if it's going to act constructively, it's going to hold here, build out maybe a mini base and fall through higher. But if it breaks below that 21 EMA, that would kind of show that something's not quite right. But we'll see what happens actually with this name here. Here's an example with LEU. Look how after the range breakout, it respected the 10 EMA, this orange line here. It never closed below it. And you're just riding it from, the 200s to, mid 350 or so. So with it just holding the 10 EMA, this is what Qualamagi does extremely well, is he's able to ride these volatile stocks that have range breakouts and early setups and just let them work above the moving average no matter how volatile they're doing, because this is a big pullback. I think this is about 15-20%, but it just recovers and keeps going. So give the stock the benefit of the doubt if it's trending above those moving averages. All right. So again, what we're talking about today is the process for finding base breakouts and how to trade them. So in terms of, a routine, this is kind of what I do. First, I review a general screen or your universe list to have a wide range of ideas. Identify high potential stocks that are moving up the right hand sides of bases and starting to tighten under a short-term resistance level. And then from there, any ones that are really interesting, forming tight areas, have priming patterns, I put them on my daily focus list, which is 1 to 4 stocks. So I don't have much to focus on in the morning. And I prioritize stocks and ranges, ideally with priming short-term patterns, like I mentioned. And then, like I said, I set early alerts below the pivot point. This is my overall process for finding and trading these base breakouts. For the general screen, I use the Deep View Leader screen. It's fantastic. And then I sort by RMV. And I'll actually go ahead and show that right now. So this is the Deep View Leader screen. This is Deep View. This is our general screen. And like I said, RMV is just a measure of contraction and volatility. And when it's really low volatility. So I'll actually go ahead and sort my screens from lowest to highest in terms of volatility, and spacebar through and look for a tight area that's happening up the right hand side, or something like this. AMSC catches my eye, because what do we have? We have a base, we have a move up, a pullback to the level, and now it's forming a range right near the 21 EMA. RMV is getting really low, around 2.77. So I'll just kind of spacebar through, add any of these names to a watch list, and look for setups that are happening near the 21 EMA. So this is B. This is happening near the 10 EMA. This is kind of like the RKLB chart. Tight day, inside day. So definitely expecting expansion the next day. It's a little bit short-term extended from the base, but this would be type of a swing trade setup if we break through these highs. So that's what I'm looking for as I spacebar through, is names that have tight areas on the right-hand side, and that tight area is at a spot where I can expect a move for at least a few days, or ideally a few weeks and months. And there's been a lot of moves the last few days, so there's not too many to talk about. Core weave near this overall pivot, a little bit choppy, but I'll add that. So this is kind of my overall process to create that first focus list. And then I go in and say, okay, from that focus list, what are the top 4 that I want to focus on the next exact day? So I guess, again, I'm looking for tight areas that happen up the right-hand side of the bases. So this one, SHC, we've got a base here. We've got a pivot right here. 2 tight days. I'd be watching for a breakout through here. RMV is going to 0 and watching for a push here. I like the upside reversal here. And we've got a show of power, a show of relative strength, a nice move higher. This theme overall has been strong as well. So this would be one I'd add to my watch list as well. So that's just a very quick example of my process for actually finding and setting up my watch list for this. So let's go ahead and present this again. When to trade base breakouts. I said this at the very beginning of the webinar, but I want to emphasize it. Breakouts work best in the early stages of a new uptrend, especially after a significant market correction. During downtrends, pivot breakouts will be sold into and or will not follow through and not work, and you're going to chop yourself up to pieces. So this is best used when the QQQ or the market has just had a choppy period or significant correction and is now expanding and actually starting to trend higher. So best when the QQQ is above the 21 EMA, especially in the early time periods of that. Don't force pivot buys in bad markets. I want to emphasize this. Don't force pivot buys in bad markets. You're just going to have a lot of stop loss hits, and they're not going to follow through and make progress for you. So this is a really key slide to remember, especially during choppy environments like 2021. No pivots were following through. You could trade that first day and it might work and then sell to strength, but you wouldn't get any follow through. The best environment for trading base breakouts and pivot breakouts is when there's follow through and stocks are moving strongly from the actual pivot point and following through in the next days and weeks. So that's the type of environment to focus on for base breakouts. Key reminders. Base breakouts are one of the most powerful and repeatable setups. We are looking for early entries before it's extended in the eyes of the market. We want to develop a trading a base playbook with entry tactics. We talked about how to do that today. Look for clear pivots and priming patterns like we discussed. Prioritize tiger stocks, high potential names in strong themes. Manage risk tightly and logically. And once a breakout works, let the stock trend naturally above the MAs, especially in strong markets. Give it the benefit of the doubt when you have cushion. You'll be amazed about how these names can trend. I did not expect LEU to just take off and go, but in strong markets, that can happen. So you want to use the asymmetry of the market in your favor. We want to cap the downside, but let the upside be, unlimited, trending above the moving averages. So this is a really key bullet when we're in a strong market environment. All right, so that's pretty much it for today. Thank you so much for your time. I'll see if there's any questions coming through, but please, if you enjoyed today's webinar, go ahead and scan this QR code, and I'll drop the link in the chat as well to share your feedback. It'd help me out as I do future ones, and just would be great to hear what you guys think. So let me go ahead and drop this link in the chat here. So here we go. All right. Let's see if there's any questions coming through. There's one. Richard, do you prefer sloping pivots or horizontal pivots, and why? I gravitate more towards the horizontal pivots just because they're a little bit more clear cut, and you can actually see on an intraday price chart how they're respected or not respected, versus a sloping line is more for identifying an area of interest. So for me, I like horizontal a little bit better. All right. Do pyramid position? Yeah, that's kind of what I talked about combining maybe the undercut and rally setup with the range breakout. Is you can buy 50% on the undercut and rally, the oops reversal setup, and then 50% add on the actual range breakout. So definitely use that to build into a position while managing risk, especially if I'm really focused on the name. All right. Let's see here. Let me know what your favorite takeaway from today. Yeah, Giancarlo, put in all caps, don't force pivot buys in bad markets. 100% agree. And if you guys enjoyed today's webinar, please leave a like on the video and subscribe if you're not already to the channel. I'd really appreciate it, and it helps let other traders know to take a look at this resource. All right. Let's see here. What's the max percentage of your portfolio you would allocate per trade? The very max is around 50%, but that's in a special situation when I can manage risk very tightly. I don't want to risk more than 0.05%. 0.5% of my portfolio on any kind of one entry, but I'll build into a position sized higher than that. All right. Abdu says the slide on priming candles is great. Awesome. Definitely remember to understand it versus just memorize them. You want to be able to use those creatively. DFU leaders, it's looking for momentum. It's looking for relative strength. It's looking for leading groups and themes. That's what makes up the DFU leaders screen. My usual win rate is under 50%. It depends on the market environment. It's been strong lately, but it's typically under 50%. But that's why we have stop losses. We keep the losses very low relative to the wins. Thank you, Dave. Appreciate it. Awesome. All right, guys. Thank you guys so much for tuning in. Appreciate it. Again, please leave a like down below. Give me feedback. That would be awesome. I'll drop the link in the chat one more time. But appreciate you guys spending your time with me here today. Hopefully this was helpful to you guys. Hopefully you got a few good bits of information that can help your process. Again, it's not about memorizing patterns. It's about developing a process that links everything together so you can actually execute. So I walked through the entire process that I use to trade Breakout today, and hopefully you can find, bits and pieces that help you guys in your process. So thank you again for tuning in. I appreciate you guys immensely. Thanks for the kind words and feedback. And I'll see you guys in the next webinar. I'll keep an eye out on your emails. I'll be sending out the links and registration forms for the next webinar very shortly. So keep an eye out on that. And also later today, I'll be sending out that model book. So look out for that, and definitely take your time going through those examples. And the best way to use that, and I'll actually show an example here. Let me go ahead and bring up IONQ and present. The best way to do this is quickly look at the time frame I look at on the chart, bring it up on your own screen, and try to annotate it yourself before you look at, my annotations. And then, you're going to catch stuff that I don't catch. So then go ahead and look at my annotations, go bar by bar, how I point out inside days, bombing range breakouts, all this stuff. Take your time going through it. And, study it. Don't just try to quickly go through a lot of the examples. Go through 5 a day or 5 each weekend. And that way you start to really build an ability to see these characteristics for yourself in real time. And that's what we want to do at the end of the day. So enjoy this model book. There's a lot of great examples recently. Grail, really great. Breakout as well. So there's so much to study recently. And also there's a bunch of historical examples in here from the Trader's Handbook, Breakout's model book that I'm including. So enjoy it and look out for that later today. So thank you again for everybody tuning in. And yeah, I'll send out the recording link as well when I've got it. So thank you so much again. And I'll see you guys in future videos. Have a great rest of your weekend and take care. Bye.